Welcome to week 4 of Money and Banking. After we've covered fundamental concepts of credit like yield to maturity and rates of return last week, we'll now move ahead from the basic financial mechanics to the economics of credit markets. Interest rates are a central quantity of interest when describing credit market conditions, and this week we will focus on the question what determines the interest rate on a single specific asset, like say a corporate or government bond, or something like a mortgage. But now you should recall that interest rates, while specific to each credit contract and borrower, measure that borrower's specific cost of borrowing. Credit conditions, such as access to and the cost of borrowing, affect all components of aggregate demand, like firm investment, household consumption, or government budgeting. For this reason, credit markets are central to macroeconomic and central especially to monetary policy. While credit markets with their myriads of assets and derivatives are complicated creatures, some basic economic models exist, at least at a top level, which can describe the behavior of interest rates in fairly intuitive ways. Now, historically, interest rates have been anything but stable. For instance, the yield on the US 10-year Treasury rate increased from 4% in the early 1960s to nearly 16% in the early 1980s, before gradually falling again to its historical nadir, breaching 0.5% in March earlier this year. Now, you may recall that monetary policy affects interest rates more generally, although the Federal Reserve does not target the US Treasury yield. Instead, it targets the federal funds rate, an overnight banking lending rate. However, for arbitrage reasons we will discuss next week, reducing the cost of borrowing for banks, at least in principle, should also reduce the cost of borrowing for everyone else as banks pass on the stimulus. While it's less clear how effective such policy is when interest rates are near zero, the overall decline in interest rates in recent decades cannot exclusively be attributed to monetary policy. About an estimated 50% of it is instead associated with slowing population and productivity growth in developed nations. Before we jump into such nuances, let's begin with basics. We will cover two models this week which explain the interest rate on a single instrument like a treasury bond. The first is a micro-style partial equilibrium model of supply and demand, known as loanable funds, which explains the interest rate as a function of supply and demand of a particular bond. The second model we will cover is a macro-style general equilibrium model, which explains the interest rate on a bond in relation to the money market. This model is known as liquidity preference, and you have seen a version of it in your intro classes. Next week, we will then discuss how interest rates on different credit instruments relate to each other, which is the discussion of the risk and term structure of interest rates. Starting with the loanable funds model, a word you won't find in the dictionary, which you, however, can simply replace with credit if you wish, we're looking at a basic 101 style model that starts with the straightforward insight that demand and supply for an asset like a bond determine its price. We already know from last week that bond prices and yields are inversely related. If you pay more for the same expected contractual payment stream, you earn less per each $1 invested in interest, and that is, of course, the interest rate. So if we can determine which factors move the demand curve for a bond and its supply curve, we can make a prediction about its price and then equivalently its yield. Starting with demand, there are four broad categories of drivers: wealth, expected returns, risk, and liquidity. As you probably know, wealth is simply the total amount of savings available in an economy. Accumulated wealth comes in form of many things like buildings, machinery, cars, and so forth, and among other things, it comes in form of financial assets. Now, in a 101 micro world, if aggregate wealth in an economy increases, all else the same, or ceteris paribus, demand for financial assets generally will increase. The opposite is true when wealth contracts. This gives asset demand a certain cyclical quality. For instance, because people have more disposable income they can save during an expansion, demand for stocks or 401k fixed income securities, like for instance bonds, increases during an expansion. By the same token, as individuals lose income during a downturn, sorry about that, here we go. By the same token, as individuals lose income during a downturn, asset markets often suffer, perhaps most notably in form of stock market crashes. Number 2, expected return. Remember from last week that the bond's rate of return is approximately given by its current yield and capital gains. Generally speaking, a higher expected return for one bond, all else the same, makes it more attractive than another. Keeping in mind that at a time an investor needs to make a decision about which bond to buy out of the many available options, practically all components of bond returns other than the current prices are unknown. Consequently, a bond buyer, or any buyer of financial assets really, must form an expectation on what the average return on an asset may plausibly look like. In practice, predicting the returns on asset classes or specific instruments is a complicated affair and requires the use of regression and other higher level financial math techniques. However, for all practical purposes, expected returns are simply a complicated variation of the simple expected values you have encountered in your intro stats classes. That is, they are a probability-weighted average of predictive outcomes, potentially contingent on a number of other variables that determine them as well. Now, if you don't exactly remember what an expected value is, here's a simple napkin explanation. To find the expected outcome of an action, like for instance buying a bond, first find all possible outcomes, then assign a value/payoff to each outcome, along with a probability for each outcome occurring. Finally, sum up the payoffs times the probability, and you'll receive an expected outcome, which is simply the probability equivalent of an average. Now, statistical concepts are easiest explained using gambling examples, so let's quickly practice this on American roulette. If you don't know anything about American roulette, it generally has 3 possible outcomes if you place a simple bet on a color, which is one of the easiest bet you can place. The ball can either come to rest on a red number, it can come to rest on a green number, or it can come to rest on a black number. Say you bet $100 on black. The associated payoffs in this case with a green or a red number are $0, you lose, while you get $200 if the ball lands on a black number. Assuming that the roulette table is fair, moreover, that means each number is equally likely to occur, the probabilities for the 3 outcomes are found as follows. There are 38 total numbers, 18 red and black numbers each, and 2 green numbers. The probability of the ball landing on a black number then is 18 out of 38, and it's the same for a red number. There are 18 black numbers, there are 18 red numbers, there are 38 numbers total. That amounts to about 0.47 for each of these 2 outcomes. So out of 100 spins in about 47 cases, either a red or a black number will come up. Finally, the green number occurs with a probability of about 2 divided by 38, or roughly 6%. Now, what is the average payoff if you bet $100 on black? But the rule laid out earlier, the average payoff is simply the probability of obtaining a black number, that is 0.47 times 200, the pay of a black number, plus the probability of all other outcomes in which you get 0. This sum is equal to $94. So every time you bet on a black number in roulette, your expected win is $94. By the way, all casino games in which you play against the house work by this principle, which you cannot really win, which is why you cannot really win at a casino. Now, while the range of outcomes for a bond are obviously much more diverse than this, in principle, the concept of expected return is the same. So stylistically speaking, for instance, if a bond paid, say, 15% with a probability of 0.25 and 5% with a probability of 0.75, the expected return would be 7.5. Risk. Risk associated with an asset also determines demand. This should be intuitive. Typically, we think of default risk, that is, borrower inability or unwillingness to pay, but other types of risk, such as interest rate risk we've already encountered, affects demand for an asset as well. Intuitively, we assume that higher risk would be associated with lower demand for an asset, but in reality, this really depends on investor risk preference. Generally, we distinguish between risk aversion, risk neutrality, and risk-loving behavior, with risk aversion being the standard assumption in finance. However, examples of risk-loving behavior is not unheard of, especially in the context of asset price bubbles. Notice that risk is not the same as expected returns, and it is not necessarily reflected in expected returns either. As a matter of fact, two assets can, in theory, have the same expected returns, but display completely different risk characteristics. For instance, in this example before you, you're offered two bonds. Bond 1 pays $100 in 25% of all cases and $50 the remainder of all outcomes. Bond 2 pays $200 in 25% of all cases and $60.67 otherwise. Now you should verify that the expected return on these bonds is exactly the same. However, clearly they are not the same bonds. Bond 2 has a much larger variation in potential outcomes and is thus riskier than Bond 1. Now, a risk-averse person, as a typo here, would prefer Bond 1, a risk lover would prefer Bond 2, and a risk-neutral person would be indifferent between the two. Now, under the standard assumption of risk aversion, Bond 1 will typically be the preferred one, and as a result of that, demand for it should be higher, which in turn would drive down its price and increase its return over Bond 2. This is an outcome of arbitrage, and we will come back to this point in a little bit. The final determinant of asset demand is liquidity. This one is straightforward again. Liquidity is desirable. Generally, a more liquid asset will be higher in demand. Now, in practice, this is a function of market size. For instance, US Treasuries are much more liquid than a municipal bond issued by Pierce County, for instance, simply because there's more of them, they're more widely traded, and so forth. Before wrapping up, let's quickly talk about asset supply. This is a much shorter story. The supply of assets like bonds will increase in one of three cases. Number one is a scenario in which corporations borrow more. This is typically the case when there are more profitable investment opportunities for corporations. Those in turn are strongly linked to the business cycle. Firms will thus issue more assets during expansion than during a downturn. The second issuer of bonds are governments, and governments issue bonds largely to borrow. Simple narrative here is that the larger the public budget deficit is, the larger will be the government bond supply. So for instance, in March and April, when the CARES Act was passed, that large stimulus package that we just saw, 2.3 trillion, the US Treasury issued an equivalent amount of short-term, mostly short-term bonds. Number three, finally, expected inflation matters for both borrowers and lenders. Inflation tends to hurt lenders because it reduces the real rate of return, and it tends to benefit borrowers because it reduces the real cost of borrowing. Therefore, if expected inflation increases, issuers like government and corporations tend to issue more debt.